Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by Alan Higgins. Now, each week on the podcast, we look at the three things investors need to know. Now, that could be for the week ahead, as well as longer term trends. And we read the research so you don't have to. But before we get to that, Alan, I think you had a little bit of homework from last week or from the last couple of podcasts we've recorded. I think, first of all, I know last week there was a little bit of a debate between you and Richard Way, our UK equity expert who was on. That's for those of you perhaps that missed that one. That was from the 21st of November. And there was a discussion about Santa rallies. And you sort of felt that that kind of carried on into January. And Richard was sort of disagreeing with you, certainly as far as UK stocks are concerned, and was suggesting that January was a bit more of a hangover. And you were going to go away and do a bit of research to see whether there really was a kind of effect, a positive effect in January as well in the US.
Yeah, hi Sarah. Yeah, thank you. I'm getting better at doing this homework, so I've done it. So I'm pleased to say we're both right. I will explain. Firstly, the so-called January effect has really dissipated over the last several years. But for example, the last 50 years, UK equities in January lose a little bit of money. On average, minus 0.2%. Okay. So Rich is absolutely right. No January effect. There is a good December effect. In contrast, US and America, people being a bit more optimistic than us doom-laden people here in the UK. On average, although it has dissipated over the last several years, US equities rise 1%, with the NASDAQ up nearly 2% in January. So there is a January effect, but it's mainly in the US market and it's certainly not in the UK market.
Okay. Why do we think there's that difference? Are there any theories?
Well, one theory, which is, behavioral, is that, I don't know about you, fresh start, a bit more optimism for the start of the year. Do you think like that? Or do you just think...
Well, are we suggesting that the British are not very optimistic and the Americans are?
I think that's almost certainly true on balance, maybe for the right reasons. So no, look, I don't think you should put a lot into this data. We did talk about how the panic to get money in December may mean something. I think in January, to a certain extent, some firms work. We've got 100 million to put in the market this year. Let's get going. Let's get a head start on it in January. Maybe, but really, I'd like to think those days are gone. So investors shouldn't really rely on it, but at least statistically in the United States, January is a pretty good month.
Okay, so what we can conclude is that you're both right, which is always the optimum result, isn't it? You and Richard were both right.
Exactly.
Okay, and then we used to cover the data. We do it less now because we know that a lot of people listen to the podcast. Perhaps they're catching up maybe a week or so later. But we wanted to just talk about this a little bit. Inflation data is looking much better, isn't it? Just generally, without talking about specific figures.
Yeah, exactly. And by the way, I listen to other podcasts. And we must kind of cover some of the other podcasts that we think are good alongside us. I listen to them sometimes even months late. So I think it's the nature of the beast. Wait for a long drive, wait for a long walk in the park or whatever people do. So big picture is, good news on inflation. So, round numbers, US 9 to 3. But even in the UK down from 11 to 4.5.
It's incredible.
Do you remember when we first started doing this, it was at Citi that were forecasting like 20% inflation?
Yes, I do remember that.
Do you remember those days? Yeah, so, but there is, remember our old friend Sweden?
Well, I was going to ask you, how's Sweden looking? Is it coming down there as well?
Yeah, but they still seem to have the Beyonce effect.
Oh, really?
People can have to Google it or go to one of our previous podcasts. They're still up at circa 7%.
Wow.
So they're struggling to shake it off.
As Taylor Swift would say.
Taylor Swift is coming to Stockholm as well. I think maybe the first place she's coming to in Europe. So there'll be a Taylor Swift event. Yeah, so the serious point is my Swedish friends in finance say the currency's too weak. And there was a serious report saying Beyonce starting a concert there. Stockholm prices went crazy, but they're struggling to get it down.
I did actually related to that. I learned a new acronym this week, which was YOLO. Do you know what YOLOs are?
Surprise me.
You only live once. And these are sort of people now that are splurging on experiences, whether it's going to see Taylor Swift in concert, going to Paris for the weekend, or maybe even buying a Birkin. That was your other bit of homework, wasn't it? Have you got me a Christmas present, Alan?
Okay, surprise. So you made me, I have to say, Sarah made me go to Bond Street Hermes. One lunchtime, I had my vintage Hermes tie on. So I thought, firstly, how busy it is. You even to get into the store. Okay. Wow. Then I get into the store, a queue to talk to someone. Goodness. And then I talk to someone. I spoiler alert, I do not own a Birkin bag.
Okay. But it's on your wish list though, isn't it, Alan?
Yeah, no, so certainly, conversation. I had a very good conversation and great staff, super polite, very busy. Goes back to, okay, it's in the luxury area, but, economy slowing, no sign of it there. Yeah. So how it works is, you have to create a wish list, and I may wear Hermes ties, but they're vintage. Always looking for a deal, and it didn't impress them, it seemed. And they really won't divulge much in terms of what you need to spend to get to the top of the list, if there is a list even. It's all very vague, because obviously what they don't want is someone like me saying, you said if I bought these 2 more ties or 3 more ties or this, that, and the other, I could buy a Birkin bag. So, but go to the point. Yes, Birkin bags. When did we talk about Birkin bags, Sarah?
We talked about Birkin bags. Well, originally we talked about them back in August, on the 8th of August, when I gave a little 101 primer on the history of the Birkin bag, but as an alternative sort of an alternative investment. Essentially, we looked at
store value. So they are, but look, it's pretty difficult to buy at face value. Face value being, the price of the job is even me looking somewhat respectable with a Hermes tie. So I'm quite pleased. That would probably set me back £10,000. I don't know what the face value is.
Well, this is the trouble. It's actually quite difficult to work out what the face value is, but depending on the leather. But yes, I think you're probably talking about 10,000 plus. If anybody does know, please let me know. Sarah Muir at Coutts.com. Okay, so well, that's all the kind of homework done. So what are the 3 things we need to know this week, Alan?
Well, one of the things you suggested, I think, was a good idea, because you've noticed that Japan is a relatively buoyant market, and a few articles in the FT. Yeah. You noted that. So let's have a little discussion about Japan, and also a wider context. And if you tell me to look at Japan, I can't resist to go back to 1990, the peak of the market. The second area, you're talking about reading the research, index-linked gilts. We referenced it in the very good article in the FT. I've done some work on it in terms of, has it been a good deal for the taxpayer or not? We'll look at that, and corresponding for investors. And it's quite a mixed message, I would say. And then finally, we'll have a go at doing something that Byron Wien used to do every year. Sorry, before he sadly passed away. And remind our listeners what that's about.
Yeah, we will do. Okay, well, let's kick off then with your favourite subject at the moment, which is index-linked gilts, linkers, also known as. And we first talked to, I think your most recent rant on the subject of linkers was back on the 7th of November, if anybody wants to go and listen to that. But we were talking about, there's an FT article that was sort of looking at whether they'd been a good idea or a bad idea as far as, the UK was concerned and investors were concerned. So thoughts on that?
Yeah, exactly. And you challenged me, because it ended with eminent Professor John Kay saying, well, they've probably been good for the taxpayer, having an outsized component of our debt, circa 25%, because inflation's been lower than expected. So I've done the work. I challenge that, and maybe we'll get a letter to the FT. We'll see. I challenge that because I think he's thinking of CPI. Okay, we don't want to get too geeky and technical, but inflation-linked bonds work off RPI, and that's worth an extra 1% in rounding, and that seems to have what killed that kind of message. And look, what also interested me about that article is, so I started to read the comments. I thought, what are people saying about this? Yeah. And they're a confusing instrument because there's quite a sad message saying, well, I kind of expected inflation, so I put my entire pension into inflation-linked bonds, and the portfolio is down devastating. And this is the issue if you buy it on an index basis, because 2022, Sarah, terrible year for inflation.
Yeah.
Inflation-linked bonds, good, bad, terrible year for inflation.
I would have thought they would be good, because that's why you buy them.
Exactly, because they're called inflation-linked. No, terrible. Minus 34%.
Really?
Minus 34%. Because, when you buy the whole index of inflation-linked bonds, they're super long dated. So the inflation component comes in of the last couple of years. Yeah, that's great. But they're so long dated, the interest rate risk was far more important. So as an investor, you've got to be very, very careful. But that's the first point. But the question is, so therefore, how do you calculate if it's been good for the taxpayers? Well, to do it properly, you have to look at every single issue and compare it and say, okay, what happened if they issued a normal gilt called conventional? And I've kind of done that, and I won't go into the research, but a simple way of looking at it. So this is in contrast to the very long dated. I compared quite short dated bonds, one that's been going for a long time. And they're both 20 years, basically. They both had 20 years of existence, and they both mature in 6 to 8 years. So not like the example that poor investor had. They're short dated enough for inflation to be important. So this is the bottom line. The conventional bond, this is from an investor's point of view, the conventional bond, I'll round the numbers, the conventional bond over the last 20 years, 160%. The inflation-linked bond matched it, but until the last 3 years, up 220%. So about a 60% difference, of which 40 to 50% came in the last few years. So basically, the last 3 years, taxpayers, the other way to look at it, if an investor received 40 to 50%, taxpayers paid it. So we think Coutts is on the right side of that article in the FT. It's cost the taxpayers a fortune, and of course at a really uncomfortable time for us.
Yeah, because I saw that the Office of Budget Responsibility have said that they've predicted we're going to spend an additional £64 billion on index-linked gilts. Does that sound about right to you?
Yeah, it depends on the inflation forecast. Obviously, from here, look, inflation can be lower. They can be good going forward. I guess the point I'm making is that 25% of a portfolio, I look at it from an issuer point of view, inflation-linked gilts is large. The United States is down at 7-8. It's a big risk. It's too big a risk. The size is too large. And the other aspect is, if they cut back on inflation-linked gilts, pension funds would look for other inflation linking, which would help investment in infrastructure and the likes, which is, the government is keen to do. So, I think we better stop it there because we've ranted enough about inflation link. But I think it's worth saying, look, we think we are right. Have a look at the data. I'm not sure we're going to be writing to the FT, but that's our point. When you compare like with like, you see a real surge in costs right now. And the second point is, on an index level, they're very, very dangerous investments because you think you're getting purely inflation linking. You're not. On the long dated ones, you're getting a ridiculous amount of interest rate risk.
And they're also super complex, aren't they? They're not for retail investors. They are really for professional investors.
I think so. Actually, regulatory, I think that actually retail investors can buy them, of course. But I agree with you, Sarah. I think they're as complicated as some hedge funds out there. I think there's simpler hedge funds out there. But I'm with you because, this people, if you go on the FT article, read some of the comments, it makes you realise these are FT readers that have lost a lot of money on inflation-linked bonds. So these are knowledgeable people, so that's fair, Sarah.
Yeah. Okay. All right then. So that's that. So essentially, we're still coming out on the side of we don't really like index-linked bonds. We don't think in the end they are a good thing because if investors do benefit, it usually is at the taxpayer's expense. Is that fair to say?
Okay, there's a lot to unpack that. I would say, look, from time to time, inflation-linked bonds we have a fiduciary responsibility to allocate, and we will allocate it the right thing to do. But you've got to be very careful with maturity. Yeah. And then looking at it from the government point of view, just very simply, 25% too much. It's an opinion.
Yeah, it's more. That's more than double what Italy issues, isn't it? I think Italy issues about 12% index-linked bonds.
Yeah, and the United States about 8%.
Yeah. So as far as developed economies go, we are by far and away the biggest issuer of index-linked bonds. Okay. All right then. Well, that's. I'm sure we'll come back to the subject again. Hopefully, eventually, people will start to listen to us and pay attention. But anyway, moving on. Then I wanted to talk about Japan because I feel slightly like it's a market that's gone under the radar a little bit this year. I mean, I know we've had a few discussions about the Bank of Japan's yield curve control policy, and we've seen a little bit of sort of tweaking of or softening of that policy. But as a market, it's quite an interesting market, isn't it? I mean, we can talk about Warren Buffett and things in a moment, but thoughts on Japan under the radar in 2023?
I think you're right. And I think there's a couple of points here. I think it's under the radar because and I should say this is no Coutts angle here. Coutts has a full weighting, but just a normal full weighting in Japan, which I'm pleased about. But because the Japanese currency has been so weak, when translated into sterling terms, the gain is there, but it's not huge. So, for example, as it stands today, the index is up 30, amazing. But in sterling terms, only up 10. 10 is still pretty decent, but up 10. That's the weakness of the currency. But what I want to say is this, because a lot of commentators say, oh, this equity market is very narrow when they focus on the United States. Yeah, and it's true. But when you consider Japan and also actually Europe, which is having a pretty strong rally, you can see the global equity rally is broader than you think. And also, Sarah, we've talked about the Magnificent Seven in the United States before, haven't we?
Yeah, we have.
Yeah, basically Magnificent Seven, virtually all the growth of this 20% rally in the US. But interestingly, Japan is completely different. It's the other way around. So I'll just give you the numbers. So the index has done 30%, returned 30%.
Yeah.
The value is returned 35. And growth 25, just rounding the numbers.
Okay.
So so it's a very broad rally, but value's done very well. So these are Japanese banks and the likes has done very well in that market. So it just goes to show, and I think it's useful framing that this global equity market has more legs than people think. It's not just about the Magnificent Seven.
Yeah, I mean, and we see that, don't we? With Berkshire Hathaway, I see they're going to be issuing yen-denominated corporate bonds. I mean, Warren Buffett his investments in Japan are fairly narrow, aren't they? He's investing in sort of the top 5 sort of trading companies in Japan, I believe, isn't he? And he's seen as being very much sort of at the forefront of investing in Japan at the moment.
He's one of them, yeah, definitely, and he has a very nice arbitrage there. He issues very cheap yen bonds from his perspective because interest rates are still very low there. So that's great for him. And then he's into very much a value sector of Japan, as you say, these trading houses. So, it's a really nice position. But I think when he invests, it's definitely an endorsement. And look, we're not saying we've been so clever here at Coutts by having huge weightings in Japan, but we have had at least full weightings. But I think it's a very interesting market. But actually, can I go back further in time, Sarah?
Okay, go on then.
Because people be aware it's been a terrible market for 30 years. Because they had the bubble of all bubbles and quite specific bubbles. So the index is now higher. It's basically 37% higher than Jan 1990. And mostly, from a total return perspective, most of that is dividends. So 33 years on from the peak, we've made just over 1% a year, mainly dividends. Okay.
Yeah.
So if I tell you the broad market's up 37%, if I pick a dull stock in a dull sector like Toyota, car making, that's difficult, right? So if the whole market's up 37%, what do you think? I like to pick on the spot. What do you think a dull stock like Toyota made?
Well, I would think it's going to be somewhere around about that figure, isn't it? It's got to be up about sort of 30%.
So 37% total. You're going to be shocked. Toyota, since 1990, since the so-called bubble, 1,105% up.
Wow. I was way off.
I like to surprise you, Sarah.
Yeah, you definitely surprised me there.
8% compound. And the reason is, kind of little discussed, is that 1990, you had ridiculous overvaluation of banks, property, telecoms at the time. I'm trying to remember some IBJ, now a defunct bank, 150 times earnings. NTT, the Japanese British Telecom, 250 times earnings. Getting all this from memory. In contrast, Toyota was a relatively sensible 12 to 14 times earnings. And it's not an easy sector. And by the way, Honda up 800%. So it's not just Toyota, it's not single. So this is where index investing can also go wrong. When you have a ridiculous overvaluation of one, the whole market, but two, especially several sectors. We're nowhere near that, but it goes to show, look, by the way, Sony up 320%. You know, it's quite incredible. The return from Toyota rivals a lot of US stocks.
Yeah, that's incredible. That how much has the sort of Abenomics and yield curve control, how much has that impacted returns on equities for Japan?
These are theories. What we've talked about theories before, haven't we?
Yeah.
We can't prove a thing, but we'll have a go at theories. Yield curve control less, because it's not as if there's an equity bonanza, but yield curve control has just simply kept bond yields low. But there's no huge flows into Japanese equities or anything, either from Japan or from outside of Japan. That there really isn't, notwithstanding Warren Buffett. Abenomics, I think, yes, you're onto something, because in particular, he wanted to get the Japanese economy going. He wanted a bit of inflation. They've got that now, globally. By the way, Japanese inflation is about 3%. But that, after a long period of being 0 to negative, Abenomics also, the most important thing, corporate governance. Companies in Japan are not everywhere, but acting with much better corporate governance in Japan. And the latest point they're trying to make is that the Tokyo Stock Exchange is going to name and shame poor companies for corporate governance based on a price to book basis. We won't go into details, but naming and shaming doesn't go down well in Japan. So they're really trying to do buybacks and think of shareholders, the ultimate owners of the company. Okay.
Do you see, and I know I've seen this sort of quoted a few different places, whether there's perhaps the after sort of, you talk about 30 years of false dawns in Japan, could we see Japan perhaps taking back, I mean, talking about corporate governance there as well, could we see Japan perhaps becoming a more long-term or more attractive long-term perspective than, say, China?
Wow, Sarah. You can tell this is not scripted. Sarah's asking me really difficult questions. So they're both completely different, okay? So Japan is completely mature market, obviously, although it's got some really interesting fast-growing robotics companies, for example. And generally good corporations that haven't always had good corporate governance. So, I will out myself as a bull. Absolutely, I'm with you. Comparing to China, in contrast, emerging market, very fast-growing, some great tech companies, just coming to terms with the new rules of the land in China. And I think I've said it before, I'm looking for evidence that China embraces corporate governance, if you like, and says, right, okay, these companies in the technology sector, we're very happy with minority shareholders. They're not going to say it like this, obviously, having substantial returns. And for example, in China, the education sector basically has been closed down as a way of making money. And that's, put a lot of capital off investing in China. So that's a big discussion in itself, the China question.
Yeah. So essentially, we're not necessarily recommending that people go out and buy Japanese equities, because obviously they've got some challenges there with the weakness of their currency. But certainly we're saying that perhaps that compounded sort of growth over the last sort of 30 years, or certainly since 1990, probably hide some actually really strong performances from perhaps some of the more boring stocks.
Yeah, and the skew, and also a lesson, I don't think we're there. It's the only time I've really seen in my career where index investing can be the absolute worst thing ever. Because the index, obviously, by definition, we're just comparing a handful of stocks. So let's look at the numbers again. Since Jan 1990, The index 37%.
Yeah.
Toyota 1,105%. Yeah.
Yeah, you might be missing out on some of that if you're index investing. Okay, all right then. Well, that's Japan, and then last but not least, we talked about Byron Wien. He very sadly passed away. I think it was a few weeks ago, a month or so ago. For those of you that don't know, he was originally at Morgan Stanley, I believe, and then he went on to be vice chairman at Blackstone Advisory Partners. A bit of a legend in the business, partly because every year he would talk about his, 10 surprises for the coming year?
Exactly. So we'll give one. So I worked at Morgan Stanley with a bit and crossed over with him. He did much more than that. Of course, he was writing research. Yeah. If not every week, virtually every week. But yeah, but he had this very clever idea, because the world, and I'm sure you're going to see them, so many forecasts about what's going to happen. He went about it in a different way. He said, okay, I'm going to come up with surprises. So the idea is, I'm going to give one now on bonds. The idea is that the markets or investors think this is a really low probability. And it may not be our central case or even my central case, but it's probably higher than the 10% probability. So you mentioned that we read the research. So I've got the Bank of America Merrill Lynch Global Fund Manager Survey here. Okay. And record, by far, expecting lower long-term rates next year. Over 60% of investors expect lower long-term rates. And they're already at 4.5, while cash yields 5. So this got my interest. And okay, so that gets you contrarian instincts going, because everyone expects yields to fall, 1. 2, well, all the evidence shows that the global economy, especially the US economy, is holding up pretty well. Massive budget deficits are contributing. We mentioned last week about the debt clock, the debt clock. I pull it up as we speak. My US debt
how much higher is it compared to last week?
But it clicks. So I'm pleased. Well, 6.31% is the deficit right now, but it literally is eye-wateringly going up. Faster than I can read it. The debt, because that's the nature of the beast, of course. So a lot of supply coming through, and unless we actually hit recession, it's pretty hard to see rates coming down from my perspective. So look, my central scenario, for what it's worth, might be a pretty solid return from bonds. But I'm going to go with Byron Wien. Surprise number 1, bonds disappoint again after 2023. So again, take it in the vein that no one's expecting this, not no one, hardly anyone's expecting bonds to disappoint again. But we'll put a higher probability on it and pay homage to the genius that was Byron Wien.
Okay. Now, if your scenario does play out, what does that mean for equities? That's going to be good for equities, isn't it?
It depends. In the long run, equities, it's all about earnings. But in the short run, equities could be, frankly, a little bit disappointed if bond yields go back to 5, for example. So bond yields only need to go back to 5, and the income is decent enough so not to be a negative return, but not just the big positive returns that everyone's expecting. And this Bank of America research, even the title is "Bonds Have More Fun." So Sarah, you know me. Once I read that, I just have to go against it. I have to go against that and then say no, equities will have more fun. So if we're right and no recession, soft landing, then equities can have a decent year based on earnings.
Okay, so we're going to bring a few more of these, I think, aren't we? We're also going to talk to some of our colleagues to get their big surprises. But essentially, then you're saying, according to this Bank of America survey, something like 60% of those questioned thought that bond yields will be lower, US bond yields. So basically, interest rates in the US will go down in 2024. You're saying you think that probability is a little bit too high, and that we could see we could see 2024. We could see actually bonds disappointing and interest rates not coming down.
And not everyone has the graph, but the previous highs of this survey, because Merrill's are great at running this, are about 30%. So you can see it's off the chart. So it's gone from 30 to 60 people right now. And sometimes the consensus is right. let's see, but I suspect it's going to be more, so what I'm saying, in the spirit of Byron Wien, I'll go, the surprise will be bonds are all about income again, and very little capital gains, if any. Kind of a disappointing year for bonds. So that's surprise number one from Alan Higgins, and we will get our colleagues. We've got a great episode next week. Who's coming on next week?
We've got Monique Wong on next week.
Yeah. Oh, yeah. So that would be great next week because she's done some really interesting research, which I want to talk to her about.
Yes. Related to bonds, I believe. Yes, is that right?
Bonds are in there. Yeah, bonds are in there. Yeah, we'll do a bit of a spoiler. She's done the work about what you do, because it's not always when there's corrections in equities and different types of bonds, and what should you do? And I'm sure a lot of people say buy it. Well, yes, everyone says buy corrections. Not many people do it when it happens, but Monique will go through that with us.
It's easier said than done, isn't it?
Exactly.
All right. Thank you very much, Alan. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you very much, Alan, for joining me today. Don't forget to check out the podcast page on Coutts.com. And if you don't already, please subscribe to Need to Know wherever you get your podcasts. Until the next Need to Know, when we're going to be joined by Monique Wong. Bye for now.